Kim Snyder, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. Most people believe that crypto assets are too risky for the average investor. As we're going to discuss at some length in this podcast, I believe that the risk is in not investing, and that in fact, cryptocurrency may be the answer to near retirees' prayers. The Sane Crypto Mastermind is my signature program for those who want the diversification benefits and return potential of cryptocurrency, but can't, won't, or don't have time to figure this all out and keep up with it on their own. If you'd like to learn more, I'd encourage you to join my free online training called How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further at sanecrypto.com/retirement. I was going through my Ask Kim emails the other day, and one of them was from someone who was interested in the Sane Crypto Mastermind, but when she sought a second opinion from her investment advisor, he had angrily told her that cryptocurrency was a scam and that the only thing it is used for is by criminals. Now, as you can imagine, that made me pretty furious. Not because it may or may not influence whether she joins the mastermind. I could give a rip about that. What infuriated me was that this so-called advisor was so blatantly and clearly abdicating his fiduciary duty to his client. A fiduciary duty is like the Hippocratic Oath in medicine. When physicians take the Hippocratic Oath, they pledge to uphold certain ethical standards, including either help or do no harm. Under the U.S. legal system, a fiduciary duty is the legal term describing the relationship between two parties that obligates one to act solely in the interest of the other. The party designated as a fiduciary owes the legal duty to a principal, and strict care is taken to ensure no conflict of interest arises between the fiduciary and his principal. When you angrily tell your client that Bitcoin is only used by criminals and that she should stay away, not only does this person prove their ignorance, but they are very definitely not helping and are potentially doing real harm. You know, to his point, look, the CFA Institute, whose grueling 3-level program has helped train more than 150,000 financial professionals worldwide, said they, quote, will add topics on cryptocurrencies and blockchain to its level 1 and 2 curriculums in 2019. We saw the field advancing more quickly than other fields, and we also saw it as more durable, said Stephen Horan, Managing Director for General Education and Curriculum. This is not a passing fad. When it comes to opinions on cryptocurrency, you know, I can't help but think of the quote from Upton Sinclair. You can't convince a man of something when his salary depends on the opposite. Tell her you think it is a bad investment, considering her specific situation. And provided that you understand the investment and know enough to give an informed opinion, I have no problem with that. None. You know, I think actively managed mutual funds that most advisors sell are horrible investments. I'm not shy about that, but I have a rational explanation for why I believe that, and I'm happy to debate the facts with anyone, anytime. But his statement was not factual, and that really, you can probably tell, stuck in my craw, which got me to thinking about 3 myths about Bitcoin that need to go away because they aren't helpful. And maybe you have heard some of these or even, have kind of been holding on to them. The first is, obviously, one, that Bitcoin is only used by terrorists, criminals, and tax evaders. The second is that Bitcoin has no value because it isn't backed by anything tangible. And the third is that it's too risky for all but the most speculative investors. So let's start with the first. The reason this, which again is going back to the criminals, okay? The reason this myth exists is because I think it's repeated over and over again in the press. I mean, there are examples of Bitcoin and other cryptocurrencies being used by bad actors for nefarious purposes. Of course there are. The most colorful example, and the one I think that's probably most often mentioned by the press, is the Silk Road, known as the Amazon of the black market, which was run by this really surprisingly clean-cut young computer programmer named Ross William Ulbricht for 2 years under the pseudonym Dread Pirate Roberts, where you could buy anything, and I do mean anything. And when you look at the screenshots, the prices were very unfortunately quoted in Bitcoin, not, dollars, francs, or yen, right? WikiLeaks is, of course, another famous example, as they have been squeezed out of the mainstream financial system. They started tweeting about the fact that they will now take donations in Bitcoin. And of course, don't forget the Russian election hackers that used a grand whopping total of like $300 worth of Bitcoin to pay for a server. But oh my God, that's the thing that got all the headlines. It's ridiculous. Now, what's so silly about these examples is that it is cherry picking at its worst. What about all the terrorists, criminals, and tax evaders who use cash? I mean, take, for instance, the picture that I found of the $200 million in US $100 bills that was found and confiscated when they arrested Mexico's most wanted cartel leader, El Chapo. And that's apparently just a drop in the bucket. The U.S. is seeking, quote, forfeiture of more than $14 billion in cash proceeds from narcotic sales from his drug cartel. I mean, if you take a minute to think about it, like this line about it only being used by criminals, it's ridiculous. Okay, one, because criminals make use of every technology. Remember the drug dealers with the beepers, on their belt back in the day, if you're that old, I am, and then cell phones, now drones, and the internet. Are we going to, paint all of those with the same brush? By the way, if you haven't read it, I highly recommend a book called Future Crimes: Inside the Digital Underground and the Battle for Our Connected World by former FBI futurist Mark Goodman. If you want an eye-opening look at how criminals use emerging technology, and it's not, this is a little off topic, but it's not just about that. While it's fascinating, a little jaw-dropping, but it's also very actionable at the end. He gives a lot of cybersecurity tips for you. But anyway, the point is, this is just a specious argument. In fact, the fact is Bitcoin is not anonymous, as many people falsely believe. You could call that another myth. It is what they call pseudonymous, meaning it is trackable. In fact, Katie Hahn, the U.S. prosecutor in the Silk Road case, has said that Bitcoin was the way they were able to finally crack the Silk Road case and track it back to Dread Pirate Roberts. So it's just wrong in two ways. One, it just is, because, although Bitcoin is sometimes used for illegal transactions on the internet, the reality is that the privacy issues related to the public blockchain make it a really poor choice for criminals. I mean, the Bitcoin blockchain is by design, is a transparent digital ledger on which each and every transaction is registered, time-stamped, and visible to anybody who wishes to view it. If you give someone a $100 bill, No one has any idea where that has been since the Federal Reserve minted it. Okay. Anyway, you get the idea. I mean, I could go on, right? There's like the UK Treasury report that says Bitcoin's a significantly lower risk in money laundering and terrorism than cash, et cetera, et cetera. All right. It's bad. It's just, criminals may use it, but it's because they don't understand it either. All right. But, second is that this also obscures the fact that it isn't only used for criminal activities, right? I mean, it's also used for good things as well. Lots of other good things, including, among others, a store of value in economies like Venezuela, Argentina, Zimbabwe, Greece, Turkey, etc., where the value of their native currency is under constant assault by hyperinflation. It is being used to get relief and aid directly to those in need, like person-to-person monetary transfers, bypassing corrupt regimes who profit from the suffering of their people by siphoning off the aid that's being sent from the West. And yes, it is also being used as a speculative investment by some, which is not a bad, including me, right? Which is not a bad thing at all. That's often how history-altering innovation is financed at first. Without speculative investors, it's possible we would not have built, things like railroads and canals, the telegraph, or the internet, among others. Okay? More on that in a minute. All right, for now, so that's the first one. Let's address the second one. And that is that it has no value because it isn't backed by anything tangible. Now, the reason this myth exists, I think, is because it really doesn't need anyone or anything to perpetuate it. I'll confess, the first time I heard about Bitcoin, that was my first thought too. That's just where our brain goes. But it's kind of a case of we can't see our own eyes because we see with them. In truth, when you really stop to look at it, the monetary system that we take for granted every single day and have taken for granted for, hundreds, if not thousands of years, isn't, when you really stop to examine it, which, understanding Bitcoin really interestingly forces you to do, you realize that it isn't backed by anything either. One of my favorite podcasts on the media, just produced by WNYC Studios, recently tackled this topic in an episode called Full Faith and Credit.
Money is a story that we all tell ourselves.
Neha Narula is the director of the Digital Currency Initiative at MIT's Media Lab.
There's nothing inherently valuable about a dollar bill or a coin that you keep in your pocket or even a bar of gold. Those things have value because we know that other people think that they have value. Money is a network where we all collectively have decided that we're going to use it to represent value.
So, to be more precise, it is backed by something, but not what most people think. It's backed by confidence. Nothing more, nothing less. The same thing Bitcoin is backed by, just created by a different mechanism. Instead of centralization, the consensus mechanism of Bitcoin is based on math, but it is every bit as valid. And finally, the third myth is that Bitcoin is too risky for all but the most speculative investors. Now, I, of course, believe that is not true, that, in fact, the opposite is true. As I've covered in detail that's really what this entire podcast is about, right? But I did cover in detail in both episode 34, which is the 3 ways Bitcoin reduces your risk, and then again in 38, which was why should I buy Bitcoin, why now? Contrary to public opinion, and when sized properly, Bitcoin reduces risk in a portfolio by adding a non-correlated asset with a higher expected return than pretty much anything that you would have in a traditional portfolio that seems so far to also act as a hedge in periods of financial crisis or hyperinflation. Is it volatile? Yes. But you know what? Whenever the press talks about Bitcoin volatility, they only ever talk about the negative volatility. That is the drop from roughly $20,000 US in January 2018 to the roughly $6,500 today. But they never talk about the positive volatility. In 2008, 10 years ago, Bitcoin began trading publicly at 5 cents US. Today, it's 6,500. That's something like a 13,000% return. It doesn't take a big investment to make that pay off pretty handsomely. One of my favorite finance writers is Morgan Housel. He writes over at the Collaborative Fund, collaborativefund.com. He has a recent blog post on risk management that, of course, I will link to with everything else in the show notes. And he starts with what Jeff Bezos calls the regret minimization framework. He says, project yourself to age 80 or 90. Looking back on your life, you want to minimize the number of regrets you have. So a regret in Bezos's framework is not, a challenge or a mishap or a period of misery or unhappiness, okay? There are many things that are painful today, but you may not regret tomorrow. I say that all the time. Once you frame risk as avoiding regret, the question then becomes, okay, and again, so this is quoted from the Housel argue, who cares what's hard, but I can recover from? Because that's not what I'm worried about. I'm worried about what will I regret. Now, you and I may regret different things, but Housel boils them down, and I think this is exactly right, to two things that are universal. One is a decision that can't be easily reversed, and the other is a decision with a downside so severe that you can't recover from it. So in the first category, we're talking about long-term commitments that can't be reneged on. Examples are concentrated illiquid investments or debt that can't be discharged, like student loan debt. A lot of people are regretting that right now. He says stuff that you can change your mind about, careers, friends, spouses, employers, liquid investments, are not necessarily long-term regrettable, even if dealing with them sucks in the short term. The other category are decisions that you really can't move on from. Getting literally wiped out, late in life, getting banned, getting convicted, severe reputational harm, okay? So that leads us to understand risk management as consistently avoiding decisions that can't be easily reversed, whose downside will destroy you, permanently destroy you. With that as the framework, then good risks, and there are such a thing, good risks are those that you will both regret not taking and won't regret if they backfire. This was Bezos's point. What he was saying was he would regret not trying to build Amazon even if it had failed. Which dovetails perfectly with the Charlie Munger quote that I'm so fond of, where he says risk to us, meaning he and Warren Buffett, is 1, permanent losses of capital, and 2, the risk of inadequate return. So with Bitcoin, the fact that you have this outsized return potential gives you optionality. If it does someday go to 100,000 or 1 million, I'm not saying it will, but there's an argument for how it could. That would be a regret of a risk not taken, like not starting Amazon, right? Allocating a very small portion of the portfolio to it, make sure that you won't regret it if it were to go to zero. That, in my book, and to a professional investor, is a good risk. Not something to be afraid of, just something to be managed. So, as always, I hope you found all of that helpful. If it was, I have a favor to ask. The same one I always ask. I'm sure you've heard me and other podcast hosts ask you for reviews on iTunes. And that is because those reviews don't only make us feel good, which I would be lying if I said that they didn't, because they do, but they also tell the iTunes algorithm to show this podcast to more people by sending an important social signal to the algorithm and potential listeners that I'm producing high quality content that my audience finds helpful. So if that is you, please take a moment to do two things. I know I hear it all the time, and I generally don't do it either. But when, something is just really super valuable, right? I make myself stop and go write them the review, which reminds me, I actually have an Amazon review to write for a company that just gave me incredible customer service. Incredible. So anyway, so the two things are, one, to subscribe to the podcast, and then two, to leave me a 5-star rating and a review with comments and feedback, because that engagement is so important, like so many others of you have done. And if that's you, I appreciate you so, so much. Also, if you'd like to learn more about striking the right balance in your cryptocurrency investments and my system for doing that, I recommend my free online training, how a little bit of Bitcoin can make your retirement savings go a lot further, at sanecrypto.com/retirement. You can get the full show notes of this episode, including links to any and all resources mentioned or used or quoted in the podcast, in the podcast at sanecrypto.com/podcast. Slow down, Kim. And then finally, if you have a question about today's topic or anything else, just email me at askhim@sanecrypto.com. I read and answer every single email personally, as you saw today. In fact, I take some of them personally, as well as answer them, some of them here on the show. Everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. That is it for me. I am Kim Snyder, and I'll be back next week. Until then, may the crypto gods continue to smile on us all.